Hi, good morning, and thank you for joining the webinar. My name is Jeff White. I'm a director and one of the investment advisors at Equivest, and today we're going to review life settlement investments and how they bring institutional profitability for individual investors. So today we're going to look at the life settlement market and explain benefits to seniors, and then also explore the benefits for some investors. Also on the phone, I have with me Ben Reese, one of our investment advisors, and he will also be participating in the webinar. Let's look at some of the features of life settlement investments. They have no linkage to the stock market or bond market, so there is no day-to-day or month-to-month type volatility. They perform in any economic condition or geopolitical climate. There are no ups and downs in the investment market nor the returns. So these fixed returns, they routinely provide double-digit gains on the investment capital. And these investments are regulated by the state of California under the Department of Corporations. Your investment into life settlements can be made with qualified funds such as IRA, 401k, Roth IRAs, and they all grow tax-free. And these investments are backed by some of the world's largest financial institutions, as you'll see here in a few moments. Those life settlements have been around for quite a while, and most individual investors don't know about these, and because they have recently been brought forward and offered in various states due to legislation. However, back in 1911, there was a Supreme Court case that was heard that related to an in-force life insurance policy. It was purchased by a third party who paid a premium, and then when they wanted to receive the death benefits, there were some issues around that. And so it was ruled by the Supreme Court that anybody who owns a life insurance policy has the right to sell it to a third party. They can change a beneficiary designation, they can borrow against the policy, and they can assign the policy as collateral. So the profile of a life settlement, it's a financial transaction where a policy owner, usually somebody that's 75 years old or older, they sell their policy to a third-party investor or investment group for a sum of money which is greater than the cash surrender value, but it's less than the benefit value of the policy. Sometimes a seller receives, and oftentimes they receive upwards of 4 times the cash surrender value when they sell their policy to an investor. So what happens is that the investor becomes the new owner or beneficiary of the life insurance policy. The investor in the management firm, they take responsibility for servicing the policy, for things including tracking the insured, paying all the premiums in the future because the policy is still in force, filing the death certificate with the insurance carrier once the insured passes. They collect the full benefit proceeds from the insurance company, and then those are dispersed out to the investors. And so these investments, they are considered securities, and as I mentioned before, that they're regulated by the California Department of Corporations, and this is through legislation that was passed in August of 2000. So you may be wondering, why would anybody want to sell their policy? Well, here's an example. Mr. Smith, he's 65 years old. He takes out a multi-million-dollar universal life policy on himself to mitigate the risk of owning his business and continuing his business in the event that he passes away. Years later, Mr. Smith, now at age 78, he sold his business, and he no longer needs this universal life policy. He paid about $1.3 million in premiums during those years, and he would like to get the most that he can by surrendering his policy. However, his policy only has an accrued cash surrender value of $250,000. So what are his options? He can continue paying about $100,000 a year in premium for a policy that he really doesn't need anymore. Or he can use the cash value of the policy to pay the premiums. He can surrender to the insurance company for the $250,000 cash surrender value, or he can sell the policy as a life settlement and receive a significant lump sum payment. Now, in these kinds of investments, it's been shown by various universities in their studies that life settlement investments and life settlements are very beneficial to the policy owner and also to the investors. In this example from the Wharton Business School, which is part of the University of Pennsylvania, they studied over 1,500 policies, and they found that the insured received about 3.5 times more from the life settlement transaction as opposed to turning the policy into the insurance company for its cash value. And then also in 2013, the London School of Business, they conducted a study, and they found that looking at over 9,000 policies during a 10-year period, that the policy owners received more than 4 times the amount offered by the insurance companies. And for the investors of the life settlements, they earned 12.5% annually over the 10-year period, with a high of 18.3% and a low of 11% annually. So as you can see, it's a good situation for both the policy owner and also the investor. And with that, it's really a win-win situation, because the reality of the life insurance industry is that there's $20 trillion of life insurance policies in force today. And the American Council of Life Insurance states that 88% of all policies will lapse or they will be surrendered for their cash surrender value. And that the numbers of policies that do lapse with term policies even higher. It's 99%. So you can see that the majority of these policies do not pay death benefits. And that lapsed policies is really free money to the insurance carriers, because they've assumed the risk, they've covered the insured person during a period of time. However, just due to the nature of the industry, they understand the probability of that policy being turned back in or lapsing. And so the facts about life settlement investments, just a couple of them, is that every transaction provides more money to the elderly person than they would have received from the insurance company. So it's a real win for them. One thing that the insurance companies don't like is that they have to continue paying benefits on policies that normally would have lapsed, but they're continuing to insure because the policy is maintained in force through the life settlement transaction and investment. And so here's an example going back to Mr. Smith. He's a 78-year-old male now. His policy has a face value of $5 million. His cash surrender value is $250,000. He was offered $1 million by a life settlement investor or investment group to purchase the policy. So you can see he received quite a bit more back, about 400% more back, or 4 times the cash surrender value. The premium is still continued to be paid by the investment group, which is $100,000 per year. And Mr. Smith has a life expectancy of 74 months in this example. So what happened was that the policy it was purchased, that $5 million face value now becomes the ownership of the investor. And Mr. Smith is now receiving $1 million instead of $250,000. So it's $750,000 more than the cash surrender value that he's receiving. Just to touch on some of the features again of life settlements, as I mentioned, it's regulated by the state of California. It's qualified for investment funds from your IRA, 401k, Roth, or even after-tax dollars. It's recommended that you would have no more than 15% of your portfolio tied up in life settlement investments. And also there are a number of options available with fairly short maturity terms, such as 3 to 5 years. And the life settlement investment, it is managed by a trust company that specializes in this. It's called Christiana Trust. And Christiana is owned by Wilmington Savings Fund Society, or WSFS Bank, which is a $4 billion bank. Now let's go back to Mr. Smith as the example. Say he has a life expectancy of 5.5 years, and this is determined by a medical review and medical underwriting. What's shown below here is that the return on the investment of $50,000 that's invested when the policy by an individual that is purchasing a fraction of the policy they're investing $50,000. However, the fixed return, they know that because they're going to receive a 100% return on this investment at whatever time the person passes. So if the person lived to the 5.5 years, or let's just say 5 years to round it, they're going to receive $100,000 back. That's a 20% annualized return. Plus, there was accrued premium, and they're going to receive $4,000 in premium back that was not used. So it results in a 22% return. If Mr. Smith had lived through 7 years in this example, and this is the amount, and 7 years was the time period that premiums were accrued, the investor would receive back $100,000 on that $50,000 investment, being a 14% annualized return. So this is how these types of investments can regularly produce double-digit returns year after year. Ben, I'm going to pause for a second. Do you have any other comments at this point?
Yeah, I think it's important to point out here that there are always premiums that are escrowed beyond the life expectancy, and that's just to help mitigate some of the risk to the investor. Even in the unlikely event that a elderly person would live beyond the life expectancy and beyond the period of time that even premiums are escrowed, the returns, as you can see in this chart, in year 8 and year 9 are still double-digit returns, and it's still better than we're going to see many times, investing in the stock market right now.
Oh, that's a great point, Ben. Thank you. So I'm going to continue on and show a little bit about the investment process so you understand how this works. Equivest, our organization, selects the best insurance policies that we find with our partner organization and the ones that they have purchased. And one of our licensed advisors presents the investment opportunity, and you as an investor would then decide whether you're going to invest in one of the policies. Your documentation and then your investment funds are placed in escrow with Christiana Trust. So we, as the marketing organization, Equivest, we never touch your money. All the transactions, all the financial transactions are directly with Christiana Trust, which is located in Wilmington, Delaware. And so then after the policy is purchased, you would receive a beneficial interest certificate from Christiana Trust, and that guarantees the ownership in the policy that was selected for investment. Christiana continues to pay the premiums annually from the premium reserve account. And then when the insured passes and the investment matures, Christiana will file the death benefit claim with the insurance company, and then the proceeds are received by Christiana, and then they pay the investors their prorated share of the proceeds. And just to touch on a few of the benefits for life settlement investors is that there is no 2% annual management fee, meaning and also all fees and annual premium to continue the policy in force is included with your investment. There is no day-to-day stock market or bond market volatility or linkage to that. The investment remains stable. As I mentioned before, there are many options for some shorter maturity, shorter investment periods with some policies as short as 3 years. This investment regularly produces double-digit fixed returns on an annualized basis, as described and shown in just a few slides ago. And it performs in any economic condition or geopolitical climate, and it consistently outperforms the S&P 500. So that's a summary of the life settlement investment in the process. Ben, do you have anything else you'd like to add?
Yeah, I'd like to point out just the graphic at the bottom right of this slide here. That's actually a chart of the market of life settlements. The left-hand column on the y-axis is billions of dollars of transactions, and the right-hand, of course, is time. And as you can see, there's a lot of history there as it's been growing, and this has really been a very popular institutional investment. That's why we say we're bringing institutional profitability to an individual, to an investor, and this market really is starting to grow. I think I've read a study that suggests that in 10 years or so, the market might get up to $150 billion of transactions every year or so. This really is popular. It is, as Jeff said, little bit unknown right now, but it's been around for a while. It has a great track record, and it's going to continue to provide great returns and grow as a market.
Oh, that's good information. And then also today, in 2014, this investment is the market is a little over $30 billion. I think it's close to $35 billion annual will occur in 2014, and it's been showing continual growth. And that's as a result of not only the institutional side and more investment from institutional investors, private hedge funds, certain banks, and so on, but also opening up the individual markets in various states does also add a lot to that transaction volume. And then I'd like to go ahead and open this up to any questions from participants on the webinar. Ben, do we have anybody that typed in and submitted any questions?
Yes, we do. We've got a few here. Let me review what we have. There were pretty good questions. One person asked if there was a minimum investment amount.
There is. The minimum investment amount per policy is $20,000, and that's structured that way due to the legislation in the state of California, and also through our company. What this was not mentioned earlier is that this investment through our organization is only open to residents of California.
Great. We have another one here asking about annuities. You mentioned 401ks and IRA and Roth. Are annuity rollovers a possibility here?
Oh, certainly. Annuity rollover is a possibility. The individual investor that has an annuity today, they would have to understand what annuity surrender charges there are and what impact that has on your return from that annuity. In most cases, it's a small surrender charge. However, that is gained back rather quickly by placing this into a life settlement investment, just due to the difference in what they're receiving receiving with the annuity, and then also comparing that to life settlements as far as the double-digit returns that are achieved.
We have another one here asking about if there's any limit to the number of policies someone can invest in.
No, there's really no limit. People do have to be qualified investors, and as defined by the state of California, a qualified investor is somebody that has $250,000 or more in investment assets, and that's other than their home and their primary cars. And also they have to have $100,000 of annual income. Now, if somebody is an accredited investor, that's somebody that has $1 million or more in investments. There's no limit on the number of policies or percentage in their portfolio. As far as the qualified investors, people with $250,000 or more, up to $1 million, they can invest 10%, and in some cases a little bit more than that, upwards of 15% of their portfolio into life shares or into life settlement investments. As far as the accredited investor, there is no restriction.
Right, and just to add to that too, something that we've seen a lot of popularity in is investing in multiple policies that have different maturity dates that are kind of 3, 5, 7 years, and it creates a bit of a momentum in when the returns are received and when you can reinvest into this asset class.
Right.
Sorry, go ahead.
No, I was going to say that with investing in several policies and spreading it across different life expectancies creates a risk minimization type of strategy, and helps diversify across the various policies. One other thing that I did not mention earlier in the webinar is that the investment into life settlements, it's actually a fractionalized approach, or essentially breaking the insurance policy up into shares. So there's really no one investor that would buy an entire policy, or in effect buying a portion of a policy.
Great. We have one last question here. I think they're asking about one of the risk factors and where are these policies that they can purchase into? How are they being insured? What companies are insuring them?
Well, that's a really good question, because the risks in life settlement investments are really small. The policies that are selected for purchase and investment are only issued by the top insurance companies and some of the largest insurance companies in the country. Companies like New York Life, Transamerica, American General, and so on. And all of these companies have an A or A plus rating by AM Best, which is the most prominent insurance rating company in the country. So we're only, number one, dealing with substantial companies, and these companies just do not go out of business. They've been in business for most of them, well over 100 years. And the only other risk that we see out there is a risk that the insured lives beyond, and quite a bit beyond, the life expectancy range, or excuse me, the life expectancy, and beyond the time that premiums had been escrowed for payment of premium. So the only risk that we see is that there would be a slight reduction in the annualized return should the insured outlive those projections. Well, Ben, if we don't have any other questions, I guess we're going to go ahead and wrap up. Thank you all for participating and joining us on this webinar today. If you'd like to have more information about the investment process or investment opportunity, please do give me a call. My number is 805-277-1850. My email address is there on the screen. Thank you for participating, and have a great day.